folks. It's Dave Burrows, Chief Strategist at Barometer Capital Management. I want to thank you guys for joining in on our weekly Tuesday afternoon webcast. We're going to focus today on what's kind of going on in the macro. It's been an important week. We had a Fed decision last week. More important than that, we had a question period afterward where Fed Chair Powell had every opportunity to make his case for what they're doing. Markets, I think, were waiting on tenterhooks, expecting him to be somewhat hawkish, and it's been an interesting outcome over the past week. So we're going to just jump right in. As most of you know, we continue to think that we are in a structural bull market in equities. And we've pointed out repeatedly that structural bull markets or long-term secular bull markets tend to be lower bound by a rising 200-week moving average. And bear markets and major corrections are part of that process. And you got to get through these corrections to get to the 2 and 3 year runs that come afterwards. And they're always uncomfortable. And of course, the thing that people are always afraid of is the type of market we had from 2000 to 2003, or the terrible financial crisis we lived through in 2007, 8, and 9. And we, like you, want to do everything we can do to avoid that. But at the same time, they don't tend to happen all that often. You know, financial crisis tends to happen every 40 or 45 years. You got 1929. 1973, 74, 40 years later. You got 2007, 8. They don't happen, every 3 years. And when you're in a structural bear bull market, you do have difficult periods like 2015, 16, 2018, the sell-off right into year end and a very fast 1 month reversal, an argument for not getting completely to cash in a tough market. We have the very rapid sell-off that took place in 2020, briefly breaching that 200-week moving average, very quickly closing back above it for that week. And what we've gone through since December of 2021. So we did come back a number of months ago in October and test that 200-week moving average. We tested it a few times since, but here we are above the range we've been in over the last 8 months. And the market's doing some repairing. If we look at the fixed income markets, our view has been we saw a generational bottom in interest rates in 2020 after falling in fits and starts since 1981. Every one of the rate hike cycles went against the grain. Everyone ultimately failed. And because we were in a disinflationary environment, eventually rates had to go lower. The question is, given this reversal that we've seen, are we in a period now like the 1950s and 60s where rates work their way higher in fits and starts? Or is this an anomaly? My guess is that we've seen a very significant reversal in rates. And that has very significant meaning for investors as to where they should focus their portfolios. Certainly, we believe you can't look backwards. This 40-year period of interest rates falling is over. And there will be periods where rates pull back, but likely at this point, just like secular bull and bear markets in equity prices, we are now into a secular bear market in bonds. So we'll get paid a coupon, but we certainly aren't going to make capital gains on the bonds likely. And you can see that we bottomed in 2020 at 40 basis points. Rates went to about 3.75, almost 4%. And over the last number of months have consolidated, pulled back to this rising moving average, but likely are not headed back to the sort of high 2s. So structural bull market in stocks, structural bear market in bonds. Looking at the bond market another way, this is the TLT ETF, which is made up of 20+ year treasury bonds, made its high in 2020, a lower high in the end of 2021, a lower high in July of this past year, a lower high at the beginning of this year, and again, perhaps the rally in bonds that has been well chased may be running out of gas. we may have inflation sticking around for longer at a more muted level than we were at a few months ago, but I don't think we're going back to 0% interest rates. If we make a comparison of equities versus bonds and compare the SPDR, the S&P 500 ETF, to the aggregate bond index in the US, stocks have been relatively outperforming for a long period of time. And through this bear market we went through, maintained that strength relative to bonds because, of course, bonds had such a weak period. When we compare this to the period we are so afraid of, 2007, 8, 9, stocks cratered relative to bonds and then started to rally. So this looked very different than this. And I think what that's saying is we've been going through a typical reset, or a typical reset ahead of what might be a garden variety recession. It certainly doesn't at this point look like a financial crisis. When we look at commodities, commodities were in a long-term structural bear market from 2008 through 2021. They rallied to the point where they reversed and broke that trend. They, in fact, rallied much longer than the stock market did into May of this past year, 5 months later than the stock market topped, and then have consolidated for a number of months in a very tight and orderly consolidation pattern. My guess is over the next period of time, we see this reverse up and out and continue on higher. But of course, we'll have to see. When we compare the DBC commodities index versus the S&P 500, it also reversed against the S&P. So when we look at stocks, bonds, and commodities, I would say commodities look most interesting. Stocks continue in a structural bull market, having been in one since 2013, and bonds have newly entered a long-term bear market, likely to make investments or significant investments in the bond market a lot less fruitful going forward. And if we compare commodities to the bond market, again, that big reversal. And we've pulled back and consolidated over the last few months, but again, we probably have seen the majority of that and likely to see commodity prices work their way higher. So let's look at cash, the US dollar. US dollar through the bear market in stocks rallied sharply as people looked for safety. They also thought, well, the Fed's raising rates, maybe a better place to have money in the US than other parts of the world. The US dollar rallied versus pound, euros, and yen. In October and November, that came to an end, and US dollar started to back off after a very significant rally. We broke the support from the lows in June and the lows in December into January and went to a lower low. And over the last week, you've seen a bounce in the US dollar, I think expecting the Fed to walk back some of their more dovish comments. But today, Fed Chair Powell stayed with the same statements that he made at the most recent Fed meeting, and US dollar backed off. So you can imagine some of the things that benefit from a weakening US dollar have consolidated or pulled back over the last week or two. Today, we got a reversal in those patterns. So look, we don't forecast about what we think should happen. We use the tools that we have to try to identify what is happening. We try to make sure that the portfolios that we run stay in tune with those tools. We're always ready to make changes. We are not married to growth investing or value investing or the US or Canada or global. Our job is to find the assets that are being revalued and focus in those areas. And we can avoid the stuff that has a headwind. So we have a lot of different areas we can focus in, different asset classes, geographic regions, sectors, or themes. But we're always running tests from our top-down modeling to identify those groups that are showing expanding breadth. Where is money getting put to work? What is seeing more and more buying take place? We want to focus in those areas. We run a bottom-up process to try to identify securities that we can use to express that view that have good fundamental characteristics that are showing improvement or getting better. Good getting better. A lot more interesting than broken getting fixed. A lot less risk. We want to see the fundamental characteristics improving and the technical characteristics supporting that view. In other words, If fundamentals look like they're getting better, but price is not behaving the way it should be, well, there's a disconnect there. Maybe we're missing something. We want a combination of both those pieces in place. So we can find securities that meet our business tests, that are fundamentally sound and technically attractive in areas of the market that we see are seeing new net inflows of capital. Well, that's where our portfolio should live. And that's a dynamic, living, breathing thing. We have to retest it every day. And most important, we have to exercise good inventory management. If we have inventory on the shelf that is not performing, we have to carve it out and get rid of it, mark it down and replace it with inventory people care about. So that's where the selling strategy comes in, and running a disciplined set of stop losses against our positions allows us to make sure that we don't let little mistakes turn into big ones by saying, well, we're right, the market's wrong, and then getting really offside. So top down, bottom up, addressing each of the factors that drive return. 70% of return comes from getting to the right asset class, which we think right now is equities and commodities. And then finding the sectors or themes within those groups that are benefiting from structural shifts, and then finding securities that express that view using our top-down, bottom-up model. We're always looking for expanding breadth, and I always will frame the conversation to show that the groups that we're in are showing expanding breadth. We measure this quantitatively. When we see deterioration in breadth or relative underperformance, these groups, first of all, wind up being examined to see if we have too much concentration, reduce our exposure. We don't put anything new to work in areas that are showing deteriorating breadth, because we know there's no bear markets ever took place when breadth was expanding. And when breadth is contracting, you might get it right, but you're fighting the tide. So look, as we came out of December, our long-term models were broadly negative. We were retesting lows in the NASDAQ in December. Percent of stocks in uptrends and the NYSE had been falling. Percent of stocks in uptrends in the global had been falling. Our short-term indicators had started to turn up. Percent of stocks trading above their 50-day. Percent of stocks with positive weekly price momentum was moving in the right direction. Percent of stocks making new highs versus new lows was improving. And the percent of stocks trading above the 150-day moving average moving higher. When we fast forward to a couple of weeks later, our long-term models turned positive. So we got more offensive. And as we sit today, our models are broadly positive. So look, we like to be invested when breadth is expanding. If I look at the S&P 500, in June, 12% of stocks were in uptrends. When the market made its low, the S&P, in October, only 10% of companies maintained their long-term uptrends. By the time the NASDAQ tested the same low as we had in October, in December, the S&P held at higher levels. And 42% of stocks were in uptrends. As we sit today, 70% of all the companies in the S&P are trading in uptrends. The most productive periods of time to be invested is when greater than 70% of stocks are performing well. It means it's hard to make mistakes. Of course, it's always important for us to see more than 1 in 2 or 50% doing well. But when 70% of stocks are in uptrends, it is a bull market. And it tends to be that when you get to a point where 70% of stocks are participating, it can go on for a long time, as much as a year at a time. So we've seen steady improvement going back to October, even though there's been a steady drumbeat of bad news. I heard Ron Barron speaking this morning on CNBC. Some of you may have heard him. He was talking about Tesla and other companies. He's had the #1 track record in the US since 1981. He highlighted the fact that since he started his business in 1981, there hasn't been a single year where the news was pervasively good, other than 1989 when the Berlin Wall came down. We were all going to get a peace dividend. In other words, we're always fighting a wall of worry. There's always things to be concerned about, and to see how the market's handling is more important than the news itself. Now, in the early January, we talked about the fact that we had 10-day period of significant upward volume versus downward volume. And that when we had these occurrences in the past, going back to 1957, look at 42 days out, 63 days out, 84 days out, 105 days out, all the way out to a year, you had positive returns. In one case, 40 days out, you were down 5%. 250 days out, on average, the market was up 26%. Here's another measure of breadth that comes from my friend Milton Berg. Milton Berg looked at a 4-week confirmation of a 7-day thrust in upward volume. And they don't happen all that often, but when they do, it tends to be at the beginning of long runs higher in the market. We saw one on January the 25th. When you take the occurrences going back to 2000, the max gain within the next 252 days were all above 20%, and in fact, significantly higher. So we maybe have some good news in the data. Let's talk about leadership. On October the 6th, at the market low, if I take all the sectors that we track and put them on a distribution curve, with the left-hand side meaning the lowest percent of stocks performing well, and at the far right side, the highest percent of stocks performing well, sectors were all stacked up where almost nothing was performing well. If we fast forwarded to January the 13th, sectors moved upwards on the curve, lots of sectors in the kind of 38 to 50% range, meaning almost 1 and 2% of stocks in uptrends, but the average sector had 44% of stocks in uptrends. If we do the same measurement today, the average sector has 53% of stocks in uptrends. This is a market that's healing, and we track it every day. If it starts to change, we'll get more defensive, but it's not. If we look at the groups that have had the least amount of improvement, it's the most defensive sectors: consumer staples, healthcare, utilities, drugs. Let's look at the other end of the spectrum. Where are people putting their money? Well, these are the most economically sensitive groups there are. Steel has over 80% of the stocks globally in the sector performing well. Home builders, 70% of stocks moving higher. Machinery companies, aerospace, restaurants, apparel, insurance, semiconductors, all highly economically sensitive groups. The market is looking beyond the Fed cycle. It's looking beyond a slowdown coming at us. It's making an assessment that it may be that employment is so strong that the market can handle these higher rates. Remember that when rates started to move higher in the 50s and 60s, they didn't go right back down to zero the first time you had a recession. They pulled back a little bit, but maintained higher levels. Markets can perhaps handle these higher rates. So let's look at the groups. Financials, probably one of the most important groups we could look at. This is a group that benefits from rising rates. It's a group also, though, that depends on the consumer being healthy, depends on people being able to pay their debts. When the market made its low in October, 36% of stocks were in uptrends. 50% of stocks were in uptrends at the end of the year when the NASDAQ made a lower low. And today, 62% of companies are in uptrends, and we have completed a reverse head and shoulders bottoming pattern. And all of the moving averages are now moving higher. This is led higher by capital markets dealers like JP Morgan and Morgan Stanley, but also carried higher by the insurance companies, the property and casualty companies. Barometer has significant weights in these areas. Let's look at the industrials, another economically sensitive group. Again, completing a reverse head and shoulders bottoming process, now trading above all of the moving averages, 200-day, 50-day, 21-day, 9-day, and about to make new multi-month highs. Materials, we spent lots of time talking about that. It completed its bottoming process right at the beginning of the year, moving nicely higher. And as the US dollar has strengthened over the last week, it's backed off a little. This is not going to go straight higher. Certainly, the NASDAQ's had a nice bounce over the last few days. We're going to talk about that in a moment. My guess is that is not leadership in this market, but certainly there's a lot of people who've been short. The amount of short covering over the past 2 weeks is record setting. So many people had built in doomsday scenarios for the market. If you look at the energy sector, now this has been the best performing sector since 2020. And certainly we've seen improving breadth, 14% of stocks in uptrends in July. When the market made a lower low in October, 20% of stocks were in uptrends. In December, 48% of stocks in uptrends. And again, with the US dollar rallying, these pulled back a little over the last 6-7 trading days. Today, US dollar backed off from the Fed comments and energy took off a bit like a shot. My guess is we could be into the next move higher in energy. Now, it's highlighted by Chris Ferrone at Strategas that we had pulled back to a 3-month relative low versus the S&P. In other words, other groups have done a little better over the last 3 months. And so the question is, does that mean that the move in energy is finished, given the fact that it's been such a strong group off the bottom? And certainly, I think there was some profit taking coming into the beginning of this year. But he highlighted the fact that if you compared the energy sector to the bear market that it went through, every time stocks sold off, the credit spreads or the extra yield that bond investors demanded to own issues that had been issued by the energy sector, this credit spreads would widen out. And that was showing that there was stress on the sector. With this little bit of a pullback in energy, there's been virtually no increase in the credit spread. So there's no credit concerns here. He also highlighted that if you compared energy as it's behaving today to what happened in the tech sector in its 10-year run higher, every time the tech sector made a 3-month relative low versus the S&P, in other words, had a consolidation, look what happened over the next 20 days, 65 days, and 125 days. You never want to fade the group that has been the strongest in the market for an extended period of time, because things do consolidate. And if they are a strong group, it'll take off and run higher quickly when you saw low. And as we talked about today, we saw the US dollar start to pull back and energy stocks very quickly took off. So we'll have to see as we go forward, but it looks like this group continues to be interesting. When we look at the oil and gas services companies, the companies that provide equipment and services into the industry, they're telling a totally different story. We today closed at a new closing high for the XES ETF, which includes companies like Precision Drilling and Schlumberger. There's a ton of small companies in this group. After consolidating through the bear market from 2014 to 2020, one way to participate is just buy the XES ETF or the OIH ETF. But we've seen steadily rising, Brett, 22% in uptrends, 40% in uptrends in December, 48% coming into the beginning of the year, 58% of stocks in uptrends as of today. And then in the consumer sector, the one group that really stands out is the home builders. If we're having a hard landing, the investors in the home building and home construction market don't know it. We have had a big higher move in mortgages and mortgage rates. But look at this, 10% of stocks in uptrends, 14% of stocks in uptrends, 44% of stocks in uptrends. And now, having completed a bottoming process, we've got rising relative strength, steady improving breadth, and now the moving averages are all hooking higher. This is a new leg higher that we're facing. Well, this was as it was a week ago or 2 weeks ago. This is as it is today. 70% of stocks in uptrends today. And the moving averages continuing to tilt higher, trading above everything, including the 8-day moving average, the strongest short-term measure of trend. So that brings me to the NASDAQ and technology. Certainly, the NASDAQ's had a great beginning to the year. But I just want to highlight that since the beginning of this sloppy period for tech, there have been a number of failed attempts at rallying relative to the rest of the market. I can tell you, when I talk to people, all they want to know about is what's happening with Google and Apple and Amazon and Netflix. And they have been great stocks over time, certainly Tesla as well. And it's not to say they aren't good companies. The question is whether they're the right kind of company to own in a reflationary environment. This, to me, is a downtrend. Moving averages are all headed lower. Now, the one group that is performing better are the semiconductors. And listen, I'm not about fighting strength. Our team has added exposure in companies like NVIDIA and Advanced Micro Devices. We do think that this is an economically sensitive group, and we are seeing expansion in breadth, and we are seeing some improvement in the moving averages. But this looks a lot different than some other groups within tech. Now, groups we're avoiding. The defensives saved us money by being in them through 2021. But I just always want to follow this relative strength line, this light green line that was moving higher until the end of the year, and then basically has fallen off a cliff since. This is relative price performance versus the S&P. So very clearly the consumer staples, which were a place to hide when the concern was we were going to get a hard landing, are seeing a lot of selling. And since the end of November have been making lower highs and lower lows. So this is a group that we're actually short in our macro fund, as we are utilities and low vol sectors in general. They became very expensive relative to history, a very crowded trade, and a group now that we want to avoid. The other group that's similar and very defensive is healthcare. And we have had through the course of the last year some pharmaceuticals exposure in companies like Eli Lilly, but we've really moved away from this group. So we're always having to make small shifts, always having to recognize change. Themes that are persistent: dividend growth. We've talked about this now for months. Very strong, steady improvement, relative price performance, trading basically at relative strength new highs. This is an ETF made up of companies with a historically excess ability to raise dividends. We've talked a lot about small cap and value theme, relative strength continuing to strengthen. In fact, this has been improving since the beginning of 2021. Small cap and value are two themes that were out of favor for many years. This ETF made a new multi-year high as of a week ago, before pulling back for a couple of days. Small cap dividend growth, even stronger than large cap dividend growth. Rising relative strength since March. Share price bottomed in September before the market made its bottom in October. It was already trading higher when the market retested the lows in December, making another higher low. We want to own things that held up longer through the decline and bottomed earlier and show relative price strength. These are the things that will lead in the next bull market. So as we sit, we continue to be pretty fully invested. We have about 22% of our client portfolios across the pools and funds and separately managed accounts, 22% in financials. That's up pretty sharply from a month ago and roughly double the market weight. We think this group is still relatively underowned and unloved. Certainly materials are almost hated. We have a 15% weight versus a market index weight, the S&P of 2.8%, up again from last month. Industrials is 13%, down slightly from last month. We reduced our defense holdings somewhat because there's other things to do in the market. And we have about, 40% or 35% of technologies weight. This is a relatively new weight, as we talked about, in semiconductors, and a couple of dividend growth stocks, one of them including Microsoft. Energy is an overweight, although my guess is, given the activity today, we may be topping this one up. And at the bottom end of the spectrum, utilities, real estate, cash, healthcare, almost non-existent. Consumer staples, less than a half of the market's weight. So look, this is a portfolio that is not set up to act like the index. My guess is there's some big parts of the index that are going to act as anchors over the course of the year. We don't want to participate. This is a time to be an active manager and to be very targeted. The themes that have been shaping up over the last 18 months are very clearly in gear. It looks very clear to us that we put an important low in October, and we'll obviously have to continue to follow the data, but it looks as though we are into one of those 18 to 36 month periods where the market can move smartly higher. When we have bear markets where everything goes down 20% or 25%, you have to have pretty big numbers that come afterwards to make long-term numbers positive. And I think we're into one of those periods. Outside the US, Euro Stoxx 50 is making markedly improved progress. In fact, outperforming the S&P. We know Latin America is performing well. We've got some exposure to Mexico. In fact, we're making multi-year highs in Mexico. From an earnings perspective, with about half the companies reported, companies are beating the sales estimates by a little. earnings estimates by a little, but most importantly, they're not missing. And in general, the response has been positive in the market to earnings. In other words, people expected them to be very poor. Credit risk, or a measure of investor concern about the risk to own corporate bonds. Credit spreads are coming down, meaning they're demanding less extra return to own a corporate bond versus a government bond. And in fact, if we look at a 10-year corporate bond versus a 10-year government bond, the excess or the spread has just broken down and given a sell signal. We know the spread tends to increase when there's economic risk, just like there was in 2020 and like there was in 2018. And when the spread starts to come down, it tells you people are expressing a view that the risk is subsiding, not getting worse. Volatility is back into a very normalized multi-year range. So look, we watch these things every day. We watch for signs that things are getting worse. My guess is that the crowd is on the wrong foot. My guess is this year is going to wind up being a lot better than what people expect. If things should start to change, we're very happy to get defensive. But in my book, we continue to be in a structural bull market, and we have the next big lift in front of us. Look, if things get difficult, we will get defensive. We've shown a history of doing that. But at this point, I think the people that are most pessimistic in the press are probably on the wrong side of the market. Now, with that, I'm going to check and see if there's any questions. Pamela was not able to be on today. Okay, this one question. I have positions in both FDL and RDVY in terms of dividend growers. Are there dividend growing ETFs that can be bought in the TSX in Canadian dollars? And what would you recommend? There are, Robert, if you wanted to send me a quick message, I can send you a small list. I won't give them to you off the top of my head, but certainly we can answer that. Anonymous attendee, Finny released their earnings today and beat the estimates. However, downgraded. Are you still a holder? Yes, we are a holder. We really like the industrials. We like the machinery stocks. We like Cummins Diesel. We like Caterpillar. We like Finning. Certainly, with the U.S. dollar bouncing over the last few days, it was put a little bit of pressure on the industrials. My guess is that bounce in the U.S. dollar is not going to be long lived. If you look at the technical structure and technical setups, they've only just broken out a multi-year basis. So my guess is there's a long run to be had there. Why do we have such a low allocation in real estate if rates seem to have capped? If you think about it, the thing that is most helped by falling interest rates is real estate. If we think that we maybe have seen a short-term high in interest rates, like short rates, it doesn't mean that we think we've seen a high in the longer-term rates. The market right now is thinking about this year and next year and the year after, the first 1 to 3 years. When you go out to 10 years, there's very little risk built into the pricing that rates could continue higher for the next 10 years. So I think that when we look at the yields on a 10-year bond or a 30-year bond, they are likely to continue to work their way higher as the market recognizes we may be in a reflationary environment. That'll make it very hard for leveraged assets like real estate. So as rates came down from 10 to 1, the cap rates on commercial real estate came down from 10 to a very low number. My guess is it's going to be hard to go the other way. Last question is, do we consider pipelines, Enbridge and TRAP, to be part of the energy or utilities? They're a combination of both. They are probably somewhat less attractive than energy producers, although they're more stable. Enbridge has a little bit more growth attached, which makes it a little bit more interesting. But yes, they will be held back somewhat by the fact that they are large utilities. And unless there's any more questions, let's see if there's more here. Oh, there are a couple more. Can you give us some thoughts on emerging markets and in particular, small cap dividend ETFs? I think that they look interesting. So far this year, and since we saw things start to improve in the fall, global equities are outperforming US. Canada's outperforming US. So I think that you have to take a look. If we think the US dollar is going to weaken, emerging markets probably perform well. The dividend theme will work well there as well. My guess is probably a good area to look, and I would recommend taking a look. And I think that that's it. Oh, I've got a message from Lawrence, and you've given me an email address. I'll answer that as best I can and shoot a message back to you. So thanks everybody for joining in on these Tuesday calls. If you got things that you'd like us to cover, please let me know. We'll be on again next Tuesday. Next Wednesday, we will be hosting a call just to give an update and a discussion around what's going on with music royalties and our global music royalties fund. In a world where virtually every asset was down 20% last year, it was up a little over 11%. And we certainly held back on valuation there. My guess is it's set up for another pretty good year. The yields have been above 7%. And certainly lots of people getting involved. It's becoming a financial asset and a great diversifier against portfolios. We've used units of our music fund in income portfolios to give a non-correlated income return, and I think it looks pretty interesting. So that's going to be Wednesday at 4 o'clock. I'll post things on Twitter. We'll send things out by email. But if you're too shy to ask a question here, phone us up, send us a message via email, and I'll answer you directly. So thanks very much for tuning in, and we'll see you next week.